Before we get to the question that Marty addressed about whether it's going to affect lending or not, first of all, tell us, why did Michael Barr think he needed this at all? What's the issue that they're addressing?
So a couple things. One is we still haven't fully implemented Basel III in the United States. So there's been a lot of conversation for a long time around Basel III endgame and helping to bring the U.S. into conformity with some of the international standards they've agreed to. But Michael Barr has gone further. Vice Chair Barr, very shortly after taking office, said he's going to engage in a broad, holistic review of capital requirements. There's a whole host of requirements that were put into place in Dodd-Frank, modified somewhat since then, and he wanted to take a more comprehensive look of how they work together, how well they were working, and the changes that needed to be made. So what the speech was a summary of what he sees as the problems and how he wants to proceed. And it is going to mean more capital for all of the large banks.
So let's go beyond the banks and the effects of this potentially and go back again to what Marty Zweig said, what Randy Quarles is saying now. I talked to Brian Moynihan of Bank of America 2 or 3 weeks ago, and he said it's a very simple thing for Bank of America. For every 100 basis point increase in the capital requirements, it means $150 billion less in loans. Does that sound right? And does that really have an effect on the real economy, as it were?
Again, a bank CEO is going to know better than I am exactly how those trade-offs are happening. Take everything with a little bit of a grain of salt. There are meaningful trade-offs, but 2 important qualifications. So first, when banks pull back, it's hard to know how much they're actually going to pull back on lending. When they do pull back on lending, another challenge that arises is not that lending doesn't happen, it's that lending moves outside of the banking space to less regulated domains. So a lot of what we have to pay attention to is where these loans are being made. But the other core thing to note is not all lending is of equal social value, right? What we really want is more lending during periods of distress and probably a little less lending when everything's going really well and assets are potentially inflated. And so one of the things we know from history is that better capitalized banks tend to be more willing to make loans during periods of distress, which is when we most need that lending. So my guess is Vice Chair Barr's response would be, even if we have a little less lending during the good times, we're going to have more lending when we most need it during the bad times in ways that are going to make us overall better off.
Kate, I'm not going to ask you to predict the future necessarily, but is this possibly a candidate for one of those times we're going to need a little more help? We're just going into bank earnings season now, this week and next week. And there's a lot of anticipation about watching exactly default rates, delinquency rates, reserves being taken, particularly in the consumer area. There's a lot of concern that we're going into one of those difficult periods. What are you expecting? What are you looking for?
I think I'll be looking really closely at what we actually see in terms of the projections, right? So we want to know what the default rates are looking like, what is the rate at which they are accelerating. But a lot of what we want to see is what are the projections that the different banks are making regarding how much additional pain they see coming down the road. I think we're certainly going to see some challenges. And the question really is going to be magnitude. We're helped a little bit by some of the recent inflation data and hopefully some stabilization in the economy, which would mean a balancing out and a little more of a soft landing. But that can't be guaranteed. So there's still going to be a lot of noise in all the figures. But part of what we're going to be trying to figure out is there a possibility, not just on the employment side, but the employment side as it interacts with the lending and the credit of the ability of getting through all of this without too much pain.
Kate, when you and I last spoke on Wall Street, it was in the aftermath of Silicon Valley Bank and some other failures. And the concern was really with some of the community, smaller banks, even regional banks being under stress. Do we have a better sense today of whether they have in fact been under stress? Are they in danger?
I think there are clearly ongoing risks with regional banks. One of the ways that we really see that is the decisions they're making about funding. If you look at the regional banks, there have been 2 trends. One, they are increasingly relying on federal home loan banks, which is kind of known as the lender of second to last resort as a source of funding. It's cheaper than at times market-based sources, but a lot more expensive than deposits. And they've also increasingly been relying on types of deposits that are more expensive and more flighty. So if we look at kind of what they're doing to fund their operations, there are certainly suggestions that there might be more pain to come.
I want to go back to something you referred to earlier, that insofar as the big banks can't lend as much money It doesn't mean that money doesn't get lent, it just goes to other places. Takes me into what we call non-banks. You and I have talked about this a little bit before. Where are we with that, and what is the risk, the systemic risk from that? Because even though they're not necessarily banks as such, they deal a lot with banks, they bank with banks, and so if they come into a lot of stress, presumably it could affect the banking system.
It could certainly affect the banking system. And we sometimes forget this because we ended up having so many problems with banks in 2008 and 2009. But really, actually, the great financial crisis started in the non-bank sector. And so it is clearly an ongoing source of concern. The Treasury Department has proposed guidance outstanding. They've extended the notice period with both an analytical framework for how we think about risks outside of the banking system, and then also a revised framework for how they would go about designating non-banks systemically significant. So I'd say one of the most important things about the revisions we're going to see if Barr's proposals all go forward, as I would expect they will, is really the importance of the Treasury and FSOC more generally, the Financial Stability Oversight Council, of really staying on top of the migration of activity outside the banking system that's already happened, that's going to continue to happen, and making sure we have the right framework in place for understanding and really responding to those risks.